Thank you for joining me on this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you minimize your losses and keep more of your profits through our proprietary market signals that are emailed to you every weekend for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Thursday, March 19th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. So to start off with here, we're looking at a 5-day chart where each candlestick represents 5 minutes of trading in the S&P 500. And we were up 0.47%, so up just a little less than 0.5% for the day, and we closed at 2409.39 on the S&P 500. And you can see here on this 5-day chart that the trend is still down and to the right. So, again, not a positive trend. However, 2 days in a row now, we've challenged this 2350 level. And we'll look at it again on another chart here in just a second. But for a couple of days, this 2350 level has held. So that is good news. Now, when we look at a 1-day chart, so each candlestick now represents 1 minute of trading in the S&P 500. So this is the intraday chart for the S&P 500. And as you can see here, we opened lower. The dotted blue line is where we closed yesterday. So we opened lower and hit our lows of the day just after the open of the market, just before 9:45, and we were down. If you go over to the right here, you can see we were down around this 2320 level on the S&P 500, and we rallied and kind of went positive and negative for a good portion of the first part of the day, and then we stayed positive in the afternoon after about 12:35, 12:40. We went positive again above this blue line, and then predominantly traded sideways with some volatility, of course. And you can see here where we finished right here at 2409.43. Again, up just a little less than 0.5% for the day. Now, when we pull back and look at a longer chart, so this is a 7-year chart where each candlestick represents 1 week of trading in the S&P 500. This blue line here is the most important short-term support level that we have. This is 2350, and you can see on this weekly candle here where my cursor is moving, you can see that we've dipped down below this 2350 level and challenged it, but so far it is holding. And, it's good to see us closing above this 2400 level as well. So, as we talked over the last, several weeks, this 2350 level is very important, and it's obviously where we bottomed in 2018 before we started this last rally here. And there's some trading that happened here, kind of a cluster of trading that happened in February, March, and early April in 2017. So it is providing some level of support for the S&P 500. However, I think it's going to be way too optimistic to assume that this level is going to hold. I still think that we're going to find ourselves down in here around the 2000 level, plus or minus maybe 100 to 125 points in this range here. We had a couple of years of trading between mid-2014 and mid-2016 in this level. So, guys, I really feel that this is, at the very least, this is where we're going to find ourselves. Probably within the next few weeks would be my guess. But it is encouraging to see this 2350 level holding up so far. There has been a lot of stimulus thrown at this market in various forms, including money going into the treasury markets from the Fed to keep the treasury markets from seizing up. So that's not a good thing. And as you guys have heard me talk about over the last few weeks, we really have had a perfect storm going on here with the coronavirus, the oil markets, and, of course, the bond markets. And so let's take a deeper look at some of this stuff, kind of revisit some of the charts we talked about last night. So what we have here is the S&P 500. Again, we were up a little less than 0.5% today, up 0.47%. Here we're looking at the GDX, which is the gold large cap miners. Now look at this thing. It's up 8% today. It was down huge yesterday, but up 8.18% today. The GDXJ, which is the junior miners, that's the small caps in the mining area, up a little less than 4%. But gold itself, as tracked by the GLD, the ETF that tracks gold, that was down 1.89% today. So a little bit of an interesting play here with a miners were up on the mining stocks were up, but the gold itself, the GLD, was down. And then you have the 7 to 10 year Treasury bond ETF, the IEF, which was up slightly, up 0.33%, and the 20-year ETF up 2.72% for the day. However, when we look at a little bit of a longer term chart here and just look at the performance numbers over the last week, we can see here that all of this stuff is down. You've got gold down 6.66% as tracked by the GLD. You've got the 7 to 10 year Treasury bond ETF down 1.64%, and the TLT, the 20-year plus ETF, the 20-year plus duration ETF, down 5.85 for the week. And then when we look at a 1 month run, we can see here that the ETFs that track treasuries are up slightly, so they've helped a little. But what we can start to see here is over this last week, these things have started to go against us. So I think it's really important for you guys to understand that, high quality bonds, treasuries might help a little bit here, but with these yields so low, guys, they just are not going to be in a position to help us as much as they used to. So I don't want to scare anybody too much, but the long-term problems in the global bond market, I believe they're real. Now, it doesn't mean that this stuff is going to blow up on our face anytime soon. I'm just trying to bring awareness to this so that you guys understand the realities of the situation that we find ourselves in. And also, I understand, I don't have a chart for you on this one for today, so I apologize. The data hasn't updated yet. It still has yesterday's data on it. But I understand oil rallied today, so that is helping in the oil markets. Again, that has been a huge problem with oil falling and trading as of yesterday's close anyway at the lowest level we have seen in about 18 years. So that has been very problematic. But as I pointed out yesterday, the situation with the coronavirus and oil, those are shorter-term problems that will probably dissipate to a large degree before year-end 2020. But this situation with low yields and the problem in the bond market, those are longer-term issues that we at least need to keep our eyes on. But and I'm predominantly worried about the treasury market more so than I am, say, munis or something like that. So if you own muni bonds, I'm not necessarily speaking about those. There's so many different bond types out there that you're going to have to take. If you own an individual bond in some area, whether it's a muni or a corporate or whatever, you'll have to talk to your local expert, your financial advisor, about that particular bond to see how it's acting, how it's trading, as to whether you have anything to worry about there. But in the aggregate, what I'm worried about is the massive amount of debt that's on governments around the world, and the fact that in a lot of cases these bonds are trading at negative yields, which absolutely makes no sense to me. So what we're dealing with here is the perfect storm. We've got a combination of the coronavirus, the oil markets, and problems with the global bond markets, including problems with how the U.S. Treasuries have been trading. And they're supposed to be a super liquid investment. And recently the government had to step in and infuse some cash into the Treasury markets to keep them from seizing up. The shorter term issues are going to be the coronavirus and the oil markets. 3, 6, 9 months, those should be dissipated. However, the long-term problem, and any of you that have been following my work for any length of time know I've been talking about this, the biggest long-term threat that we have, I think, to the financial markets, period, are the global bond markets. But the fact that we've got all three of these things going on simultaneously is exacerbating the situation. And if anything, the coronavirus and the oil markets are exposing the underlying problems in the global bond markets. Now, let's talk about risks. Systematic risk is the fancy way of saying market risk, and systematic risk is the main risk to equity investors. And guys, it's so important for you to understand this, and I don't think very many people realize this, that systematic risk is non-diversifiable risk. Let me repeat that. Systematic risk is non-diversifiable. So, so many people will say, well, I'm diversified, I'm fine. Well, guys, diversification, okay, third bullet point here, diversification reduces stock-specific risk However, diversification does not affect systematic risk. So by diversifying yourself, all you're doing is you're reducing the risk that you have from owning one stock or two stocks or just a handful of stocks. Okay, so that helps there. However, the bigger issue and what we're experiencing in these major downturns, any major downturn, it's systematic risk. It's non-diversifiable risk. Now, historically, high-quality bonds, U.S. Treasuries, have historically been used to offset equity risk. However, they're not working very well anymore. And I've been warning people about this for years as the yields on high-quality bonds, predominantly U.S. Treasuries, have fallen and fallen and fallen. And so Treasury bonds now are at ridiculously low rates, ridiculously low yields, guys. And so the Treasury bonds are no longer going to be in a position to help as they have in the past. Now, the realities of our current environment are that the S&P 500 could easily fall to 2,000, and depending on when you're watching this video, we might even be down there, okay? But right now, we're above that 2350 level, which would be the next level that we're going to hit. We're not too far above it as I'm making this video, but we could easily fall to 2,000, and I think in this downturn here, we're going to easily see 2,000. We could even fall to 1550 or lower on the S&P 500. It's just a matter of math. Depending on how long businesses are shut down, Nike shut down their stores, Apple shut down their stores. It just goes on and on and on and on. We've never seen anything like this before. So it depends on how long these businesses are shut down as to how much it impacts their 2020, calendar year 2020 earnings, and then the multiple that investors are willing to put on those earnings. But the combination of those two things, the earnings time the multiple, will dictate where we finish the year at on the S&P 500 or any other index or stock. So if the market, the global marketplace continues to have these challenges, right? The coronavirus, the oil markets, the bond markets, and the knock-on effect that we're going to see. Guys, we have no clue how long this is going to last or how bad it's going to get. But I just want you to understand that 2,000, I would be surprised if we don't go down there. But again, don't be surprised if this turns into a 2007 through 09 time frame, and we were down about 55% in the stock market between 2007 and the beginning of 2009, first quarter of 2009, when we bottomed. So if that happens, if we get that a similar percentage-wise pullback, that would take us down to 1550 or even a little bit lower on the S&P 500. So I just want you to understand that mathematically it is completely within the realm of possibility that happens. So do not underestimate the seriousness of this situation. It may not get that bad, but it could, okay? So, but what you need to understand too is this is our new normal in the stock market. And what I mean by that is with the inability of high quality bonds to offset equity risk, along with the massive amount of liquidity that we now have in the stock market due to the financial system being so automated these days, algorithms. What I'm seeing, and I've been at this a long time, guys, decades, and what I'm seeing is that this increased liquidity has brought about quicker moves in shorter time frames. So we've increased the velocity of the move, and we've decreased the duration that it takes to achieve that velocity. Okay? So look at over the last few weeks how hard these markets have been moving. 6, 7, 8, 9% moves in one day. You just don't see that. But we've now been seeing that back to back to back over the last few weeks. So think about what I'm saying here. Even after the coronavirus and the oil markets, the problems there have dissipated. The bigger underlying problem is the bond market, and that's not going away anytime soon. If anything, that will get worse over time. There's over a quarter, and you guys can go out and fact check this stuff. There's over a quarter of the world's government bonds that are trading at negative yields. Now, 20 plus years of financial services experience, 25 plus years of trading stocks and options, I can't get my head wrapped around that. Okay, it makes absolutely no sense to me. One thing I do understand is it's not normal, and it can't end well. Okay, so I just want you to understand that this, this is our new normal in these super fast drawdowns whenever they happen. And so the bottom line is, guys, you need a loss cutting strategy, okay? And you need a risk management system, and you need a system that will help you understand risk levels in the stock market on an ongoing basis. So my risk management system is a system called Simple Market Signals. This is my system, and it took me over 20 years of research and development to put this thing together. And the final component for me finally came together in 2017. And keep in mind, guys, I developed this for my own personal trading and investing. Even with my background, I still needed this. I've studied economics, fundamental analysis, technical analysis, and I needed it, okay? So I put this together for my own benefit, but after I worked with it for a while, I have now made it available to the public. So this is my system that I developed for my own personal trading and investing, but I'm now making it available to you. And again, it's called Simple Market Signals. So the model inputs include intermarket analysis, where I'm looking at different parts of the market, including inputs from the bond market. So that's one of the things that, and this is a proprietary model, guys. I'm not going to give away my secret sauce, but I'm just going to give you, a few data points here as to some of the things that I'm looking at and why it goes way beyond traditional technical analysis. Okay, and again, it took me over 20 years to figure this out. I'm looking at intermarket analysis, which is where you're looking at stocks, bonds, commodities, and currencies. Basically, that's intermarket analysis and how they all interplay together. Okay, so I've got components of intermarket analysis that go into the model. I've got breadth indicators, but then you have to understand what breadth indicators to use, right? Which ones to use, and then how to read them and what those levels inside of those breadth indicators actually mean. I have measures of volatility. Again, what volatility indicators and measures, and then what are the levels within those volatility indicators that matter. You have to understand how to read these things, okay? Also, I'm looking at, of course, the price action of the overall stock market, and there's more that goes into this. So the model outputs, what happens after I look at all that data, the model outputs are that I have an indicator that shows me the risk level of the stock market, right? A signal that shows me the risk level of the stock market. And I also then have the trend direction of the stock market. Okay, so there's two components to this. There's a risk component and a trend component. So I understand once, I go through the data, and then on the backside, right, the model output would be me understanding what the level of risk is in the stock market at any given point in time, and I understand the trend direction of the stock market. And guys, it is super powerful. When you understand what the risk level is and the trend direction of the market, you can make a whole lot better decisions about investing and whether to even be invested or not. So now let's review the signals within my model. So first off, we have the green signal. Now, when the signal is green, this means that risk is low in the overall stock market, and the green signal has the best risk-reward ratio for equity investors. When the signal is yellow, this means that risk is moderate in the U.S. stock market. And what you can expect during a yellow signal is that the U.S. stock market is going to be sideways to perhaps slightly down. And this is a transition period a lot of times where the signal maybe had been green for a while and then it goes yellow. And then if the situation gets bad enough, that's when we get a red signal. And when the signal is red, that means that risk is high in the stock market. And the red signal has the worst risk-reward ratio for equity investors. The model behind the signals is robust and complex. I've simplified the way that I disseminate this information, and I've got it down to a green, yellow, red signal, so it's easy for everybody to understand. Again, when the signal is green, that is the best risk-reward ratio signal for equity investors. When the signal is red, that is the worst risk-reward ratio signal for equity investors. And then along with the risk-based signals, I have the trend indicator. I call it the early bird indicator, and that is a positive negative indicator on the trend of the overall stock market. And I worked on the trend indicator for 7 years trying to figure out the optimal time frame so that I know that the trend indicator is going to be positive for the bulk of most uptrends, but then negative for the bulk of most downtrends. And for my own benefit, that's what I worked on it for that long. So all of this I created for my own benefit, and I'm now making it available to you. I deliver my proprietary signals to my subscribers via a weekly newsletter. So every weekend, my subscribers will receive the proprietary risk level signal on the overall U.S. stock market. My subscribers also receive the proprietary trend direction signal on the overall U.S. stock market and the proprietary risk level signals on all 11 major sectors of the S&P 500. So not only do you get the risk level signal on the overall U.S. stock market, but you get an individual signal on all 11 major sectors of the S&P 500. So if you are a sector investor, then you're going to know what's going on with each underlying sector of the S&P 500. And even if you're not a sector investor, it helps you understand. It's kind of like lifting up the hood on the S&P 500 and seeing what's going on underneath the hood of the S&P 500. So you'll understand what's going on beneath the surface. So it's very educational, even if you only invest in the overall market or an ETF or a mutual fund or something like that. So this is super educational and very beneficial for everyone, whether you invest individually in sectors or not. My subscribers also receive market and sector performance information over multiple time frames. So I take a look at the best and worst performing sectors and give you that information. And again, it starts to show trends when you start to see these patterns emerging in the performance of a certain underlying sector, but you'll also get it for the overall market on, for the week, for the month, for 3-month period. So you start to see trends emerging. So again, very educational and very helpful. You will also receive market commentary from me and a weekly recap on what has happened in the market during the week. And my subscribers receive technical analysis data points that they can use. So along with the trend direction and the risk level signals, you will also get technical analysis data points that are super helpful. And you're going to get fundamental analysis data points. So you'll be able to look at the technical data, the fundamental data. You'll have the trend direction. You'll have the risk signals. And I think, as you can see here, guys, what I'm delivering here through Simple Market Signals goes way beyond just a signal. All right, this is massive, massive amounts of information for a very low price point. Additionally, you will receive yield curve information. So you're going to understand what's going on with the yield curve. And very few people, I think, really understand this. But, if you hear in the news that the yield curve is doing this or the yield curve is doing that, you're going to know every weekend. You're going to get this information and an update on what's going on the yield curve, what it means, and you're going to get the yield curve spread. So it really helps to round out your education and your ability to understand these financial data points. So it makes you a much smarter, much wiser, much more successful investor. And you will also get investor education information, little nuggets that I deliver every single weekend to my subscribers. And again, all of this adds up to increase your financial IQ and your success as an investor or trader.